As an investor in the stock market, I've always kept a watch list of stocks in order to track the progress of potential investments. Today, I'm going to reveal all of the companies on my watch list, also known as my investable universe, and dive deeper into a number of companies which I've recently been close to buying, but due to valuation or a perceived risk to the company, I'm yet to make the purchase. I keep my watch list on a few different platforms, but the main one is Quartrum. What I like about Qualtrim is that using the dip finder tool, I can see how the stock price of all the companies on my watch list has performed over a specific period of time. I also keep SPY on my watch list. SPY is an asset that tracks the performance of the S&P 500 index, therefore allowing me to compare the stock price performance of all the companies on my watch list and in my portfolio to the returns of the S&P 500 over time. As you can see on the chart, from a 5 or 10 year perspective, most of the companies on my watch list, let alone the ones in my portfolio, have outperformed the S&P 500. But this isn't a coincidence, and it's not because I purposely chose to research stocks that have outperformed the S&P 500. If that was the case, I'd just remove all of the underperforming companies from my watch list. Most of these stocks have something in common: their ability to produce high returns on capital. When I say high returns, I don't mean the stock price. What I'm referring to by high returns on capital is the return the management team are achieving when reinvesting the company's capital back into the business. Right, so I'm going to show you two examples. One company, company A, let's say, have high returns on capital, and the other company, company B, have low returns on capital. And we're going to look at how the returns on capital correlates with the stock price, because ultimately at the end of the day, that's what we care about. We care about the stock price. So let's have a look at company A is Ferrari. Ferrari has, if we go to annual, incredible returns on capital. If you look at this 24%, 28%, 20%, 20%, 15%, 20%, 20%, consistently every year, annually, Ferrari hit that sort of 20% range or 25% range of return on capital. And if we look at the stock price of Ferrari over time, let's say over the last 10 years, you can see companies with high returns, at least this company, has prospered and their stock price has appreciated by 700%. Now, if we look at company B, which is Ford, and again, they're both technically car companies, but if we look at the returns on capital of Ford, let's go to sort of 10 years. They're very up and down, very inconsistent, unpredictable. And what you have to remember as well, return on capital, you'd expect it to be above the what's known as the cost of capital, which is the cost for a company to basically take on debt. Minus 1% return on capital in 2022, the cost of capital is probably around 3 or 4% at that point, maybe 5% after interest rates peaked. So they're actually destroying shareholder value by producing these kinds of returns. Even 11%, 12%, it's not great because, I mean, after you take into account the cost of capital, they're making maybe like 7, 8% returns, which compared to a company like Ferrari, who are making 20, 25% returns, even if their cost of capital was 10% Ferrari, they'd still be making a 10, 15% return on their investment. And if we look at Ferrari's stock price over the past 10 years, you'll see that mediocre returns lead to a mediocre performance in stock price. Over 10 years, Ford has not provided a positive stock price return, minus 16%. So imagine you held Ford from 2016 all the way for 10 years, and you basically lost 16% of your initial investment. Unless, obviously, if you DCA'd along the way, dollar cost average, you would still, in terms of opportunity cost, you would have been at a huge loss because you could have, invested in a company like Ferrari that made 700% over that time period, and instead you made basically break even on Ford. However, high returns isn't enough on its own. The company also needs to be able to reinvest its cash to grow. And to help you guys understand this concept more clearly, I'm going to show you a video from a talk given by Terry Smith. He's one of Britain's most well-known investors and fund managers.
I'm going to show you two companies, and I'm going to show you 10 years of cash returns on capital for them. And I'm going to ask you, if you had known at the beginning of that 10 years what those returns were going to be, which company you were going to own. The snappily known company A, these are real companies, by the way, you can see between 1987 and 1997 made returns of about 30 to 40% in cash. Okay, so would you like to have owned that, or company B, which you can see in the same period made about 15 to 25% returns in cash? So company A or company B? Who wants company A? No? Good, okay. The rest of you, I take it, want company B, yes? Can I see the company Bs, just to be sure? I want audience participation here, right? Good, okay. Now, it's an unfair question, of course. I've given you insufficient information to make the decision, so I apologise for the people whose decisions I'm about to criticise, because it was a trick question. I didn't give you enough data, because I haven't told you whether or not company A and company B can invest each year part of that capital to get that compounding effect. So company A, well, if it was starting with 100 in capital in 1987 and it earned 30, would it be able to earn 35% on 130 the next year or not? I haven't given you that piece of information. That is a vital piece of information. Those of you who selected company A, you selected this company. It's called WD-40. And if you've heard of it at all, it's because you've got an aerosol can of oil somewhere at home. Everybody got one of those? Yeah. If you've got one, you never have to buy another one because it's got an indefinite shelf life, I can tell you. And the only reason you ever buy a second one is if you lose the little straw thing that you have on it that you spray. WD-40 actually stands for Water Disbursement 40th Attempt. It was a formulation by a chemist, and he took 40 attempts to get the right formulation for it. So that's what the company stands for. Thank God he didn't stop at number 39, I suppose, given the return on capital that it generates. And the WD-40 company is a wonderful little company, but it is a little company. Every year it makes a great return because that is a lovely little product, that aerosol can of oil, but it's actually got a plant that's probably smaller than this room that we're sitting in, and it can't invest another dollar each year. So yes, it does make lovely cash returns on capital, and the management are good management and perfectly logical. They pay out the cash every year, but it can't ever grow. And it can't grow value. It's like a high yield bond. It's not like a real equity. So if you selected company A, you decided to invest in that one. If you rejected company B to go for company A, the company you rejected is that one called Coca-Cola. Now, Coca-Cola's got a good but somewhat lower return, but it quite clearly is able to grow its business over time by selling its products into new markets and physically selling more of the products that it sells in order to compound. That's the relative performance of the two companies. The red line is Coca-Cola, the blue line is the WD-40 company.
Right, so I hope that example and the concept of incremental return on capital, I hope that's clear to you guys now. And moving on from the concept of high returns, I want to actually go and do a deep dive into the companies on my watch list that I've been looking at more closely as of late. So the first company on my watch list that I wanted to highlight is Ferrari, which we used in the example comparing it to Ford. And Ferrari is one of the world's most iconic brands. Ferrari is more than just a car company, as I described it in the example. As shown in the comparison earlier in the video, Ferrari produces high returns on capital, the foundation of any quality business model. Ferrari, despite selling over 300 times fewer cars than Ford, earns over 100 times more profit per vehicle, roughly $192,000 per vehicle, compared to Ford's $1,823 profit per vehicle. thanks to their premium pricing, personalization, and brand power. Ferrari's business model is a textbook example of value over volume. It thrives on scarcity, brand prestige, and ultra high margins. Ferrari's brand was built through a unique set of historical circumstances which can never be replicated. This 86-year-old company is still growing revenue consistently around 10% annually. Even better than that, Ferrari has grown its free cash flow per share at an astounding 21% annually over the past 10 years. The free cash flow is able to grow at a much higher rate than the revenue as Ferrari exercises its pricing power. The average price of a Ferrari vehicle has grown from $250,000 in 2015 to $410,000 in 2025. Alongside pricing growth, which has helped to increase profitability, volume of sales have also increased from 7,664 cars sold in 2015 to 13,752 cars sold in 2024. The main risk associated with owning Ferrari at the moment is, again, President Trump's tariffs. Although, despite new US import tariffs on EU made vehicles, Ferrari's business remains remarkably resilient. Ferrari announced a commercial policy update to shield customers from sudden price hikes. Orders placed before April 2nd, 2025, and models like the 296, SF90, and Roma will not see price changes. However, other models may see up to a 10% price increase, coordinated with dealers. As a result, Ferrari expects only a 50 basis point reduction in profitability margins, which is minimal given its luxury positioning. Analysts still forecast double-digit profit growth and high single-digit revenue growth, with 2025 margins already near their 30% target. Ferrari's stock price has continued to rise despite tariff risks, up 18% year to date. Ferrari is a company that I'd love to own one day. However, I already own a very similar company in Hermes International, so finding space in a portfolio would be quite difficult with my concentrated approach to portfolio management. The next company on my watch list that I'm going to do a deep dive into is ASML. ASML are a Dutch technology company that manufactures lithography machines, which are vital in the large-scale production of semiconductors. These double-decker bus-sized machines are used by companies like TSMC, Samsung, and Intel to print patterns using light on silicone wafers. ASML are the only company in the world that can produce commercially viable EUV lithography machines, which are essential to produce the most advanced chips. They also have an estimated 80% market share in the less sophisticated DUV market. ASML spend billions of dollars annually on research and development to sustain their monopoly position in lithography machines. They're currently rolling out high-NA EUV systems that can produce even smaller, higher density chips with more compute power at a lower cost due to reduced error. ASML's DUV machines sell for between $5 to $90 million. EUV systems sell for between $150 to $220 million. And high-NA EUV machines sell for $380 million plus. Installed base management is becoming a larger part of the business, increasing profitability as there is less cost associated with installed base management compared to producing the machines themselves. Artificial intelligence is providing a strong secular tailwind for ASML as demand continues to rise for leading edge chips, which can only be produced using ASML's most advanced lithography machines. ASML has looked particularly appealing recently due to its recent sell-off, down over 30% from its all-time high. Investors believe the stock is selling off due to political uncertainty related to President Trump's tariff proposals, and restrictions on China's purchases of advanced Western technology, such as ASML's lithography machines. Currently, China makes up around 27% of ASML sales, mainly from purchases of their DUV machines. ASML has never sold its most advanced EUV machines to China due to regulatory barriers. However, the drop in price and emergence of regulatory concerns have coincided with continued growth in profit margins and share buybacks. As the company uses its excess cash to buy shares at a lower valuation, which should create value for shareholders over the long term. I'll continue to keep a close eye on ASML stock as I could add it to my portfolio in the future. The next company on my watch list is Fair Isaac Corporation. Better known as FICO, they're the leading provider of credit scores for mortgages, used by over 90% of top US lenders to assess consumer creditworthiness. FICO also provides software tools for banks, insurers, and retailers to automate the lending process. Their software segment is a nice part of the business. However, the real story around FICO is their scores segment, which makes up more than half of the company's revenues with 90% operating margins, making it FICO's profit engine. In November 2024, FICO raised its wholesale royalty fee for credit scores from $3.50 to $4.95 per report, a 40% plus jump. Analysts expect further increases in 2025, which could add $100 to $200 million in incremental revenue for FICO in full year 2025 alone. FICO scores make up less than 0.2% of a typical $6,000 mortgage closing cost, giving the company pricing power without triggering consumer backlash. With over 95% adoption in securitized mortgages, FICO faces little competitive pressure, enabling aggressive pricing. However, FICO's aggressive price hikes have left lenders furious. Many argue that FICO's near monopoly position leaves them at its mercy, especially as a tri-merge credit report, which includes FICO scores, now cost $80 to $100 plus, with FICO's portion of those costs growing rapidly. In May 2025, Bill Pulte, director of the Federal Housing Finance Agency, publicly criticized FICO's opaque pricing strategy for credit scores. He advocated for bi-merge credit reports using data from two bureaus instead of three, which could undermine FICO's tri-merge model, the backbone of its revenue from mortgage lending. The fallout was swift. FICO's stock plunged over 8% in a single day and dropped 23% over 4 days, its worst performance since 1989. Will Lansing, FICO's CEO, has been unapologetic yet calculated in his response to the backlash over recent price hikes. Despite the turbulence, FICO's algorithms still underpin 90% of US lending decisions, and its institutional relationships remain deeply entrenched. While the regulatory spotlight is intense, the infrastructure required to replace FICO's system is massive, making any transition slow and complex. If we believe that regulatory pressure will fail to disrupt FICO's position in the lending market and price rises will continue over time, now may be a great time to buy FICO stock, as the price has fell significantly, almost 25% year to date. From a historic view of FICO's valuation, it still looks expensive despite the recent drop in price. However, we shouldn't underestimate the impact of future price increases on revenue growth and profit margins. Since FICO began exercising its pricing power back in 2018, its returns on capital have skyrocketed, indicating that the business's quality has increased. therefore justifying a higher valuation. If we take a look at another clip from Terry Smith, we'll learn that over the long term, returns on capital are much more important when buying a stock than the price you pay.
You're going to have to make a decision between investing in just one of two companies for your investment career. Pretty simple investment career. This is going to be 40 years long. You can either buy company A or company B. Company A makes a 20% return on capital. Company B makes a 10% return on capital. Just to save us a lot of sort of strenuous arithmetic, neither of them pays a dividend. They both invest all of their profits back into the business at the same rate of return. Okay. Who wants to own A? This is a show of hands thing. B, anybody? Anyone want B? No? Good. You've all been listening. Oh, there's a man with B over there. We've got a man with B. Well done, sir. Yeah. Not even my regular straight man. Good. Now, I haven't, of course, as ever with any question I ever pose, it's always completely unfair because I haven't given you enough information to answer the question. You need to know what value you buy it and sell it at, don't you? So here's what happens with these two shares. Not unreasonably, A, the 20% returner, is priced, the shares are priced at 4 times its book value. Whereas B, the 10% returner, is only trading at 2 times book value when you buy them. Okay. Who wants A? Anyone want to join this gentleman on B? Can't see any. Oh, a couple of Bs over there. Well done. Well done. Yeah, good. Okay, still haven't got enough information. How about when you come to sell them? Okay. When you come to sell them, it's all gone horribly wrong. If you bought A on 4 times book, the rating's halved to 2 times book. And that's a bit of bad luck, isn't it, really? It happens, I suppose. B, you've done very well. It's gone from 2 times book to 4 times book. The rating has doubled in the time that you sell it. Okay, who wants A now? Who wants B now? No, still a couple of B. There's your answer. If that was the portfolio, the choice facing you, A, with a 20% return on capital, bought on 4 times book and sold on 2 times book, would give you a share price return of 18% per annum in compound annual growth. B, with a 10% return, even though you doubled the rating on which you bought it when you sold it, would only get to a 12% annual return in terms of share price. If you are going to be a long-term investor, and I hope you all realize by now we are on your behalf, whether or not you are investing in a good company that makes high returns and can reinvest in its business at something like those high returns is the single biggest determinant of the outcome.
And so what Terry Smith is trying to explain here is that a higher quality company, even if you overpay and then by the time you sell at a lower valuation than what you paid, the effects of compounding, which are very difficult for, the human mind to comprehend, compounding at a high rate of return over a long period of time is very difficult for us to compute. If you do the calculations, you'll be surprised by the effects of a high rate of return. And so it basically justifies overpaying in sort of, quotation marks, overpaying for high quality businesses compared to even paying a fair price for a fair quality business. Before we move on, I wanted to show you FICO's shares outstanding over time. As you can see, the company is channeling the huge amounts of cash being generated by scores to buy back shares at a high rate. I really like FICO's business model and will consider adding the stock to my portfolio in the future. The last company I wanted to highlight from my watch list is Spotify. The world's leading music streaming platform, Spotify commands a 37% global market share, the highest among all streaming services. It boasts 696 million monthly active users and 276 million premium subscribers, adding 28 million net subscribers in 2024 alone. The company also achieved its first profitable year in 2024, generating 1.14 billion euros in net income from 15.67 billion euros in revenue. Despite recent price increases, churn, the rate in which subscribers cancel their subscription, has actually decreased, signaling strong pricing power. The biggest risk to Spotify's business model is its dependency on third-party content, especially music licensed from record labels. This creates a persistent tension between scale and profitability. 70% of Spotify's revenue goes straight to the rights holders, labels, publishers, and artists. Spotify doesn't own most of its content, unlike Netflix, who can amortize the original IP. This limits margin expansion and makes Spotify vulnerable to royalty renegotiations or regulatory shifts. Spotify's business model is built on aggregating and distributing content it doesn't own. Their moat will be weakened if labels push for higher royalties or regulators enforce new rules on streaming payouts. To combat these risks, Spotify has been investing in podcasts, audiobooks, and creator tools, verticals where it can own or co-produce content and improve margins. After finally turning a profit in 2024, Spotify's journey has only just begun. I'll continue to follow Spotify closely. However, of the companies mentioned today, this is probably the most unpredictable. That's it for today's video. I'll see you next time.